Alrighty, welcome everybody. This is Institutional Trading Strategies. I'm your host, Andrei Knight. How's it going out there, everybody? Hope you guys are doing well. Hope you're earning some pips. Let's see what we can do to help you earn a couple more. Let me show you how I go about it. It starts with good planning, first and foremost. An entry signal, even with the best of systems, won't do you a lick of good. Sorry to say, but that's the truth. If you don't have a plan. This is where trading robots fail. It's kind of funny. Inevitably, somebody will ask about trading robots, whether this one or that one is good. I used to work for UBS. I helped design a trading robot for them. They spent over $2 billion with a B dollars developing it over several years. And guess what? They don't let it trade on its own. The robot's job is to alert the human traders when there's something interesting to look at and evaluate. That's a $2 billion robot. You guys really think something you download off the internet for 99 bucks is going to top that? Now, that's not to say their strategies aren't valid. 90% of them are half-baked. If some guy really had a strategy that won 24 hours a day, 7 days a week, nonstop, would he need to bother selling stuff on the internet? Think about it. But there is a teeny tiny percentage, of course, that do have some kind of thinking or strategy behind them. Left alone long enough, they will still drain your account and fail. And here's why, you guys. They take every entry signal their system generates. Light goes off, pull the trigger. Light goes off, pull the trigger. There's no way a robot can stop and evaluate whether that entry is worth taking given the wider context. And guess what? You can. Okay, so it starts with a trading plan. I'll show you exactly how to do that. We go top down, starting with the larger time frames, working our way down. You don't start with the smaller time frame and then look up. Doesn't quite have the same effect. Always top down. And by the time you get to your primary trading time frame, then you're not just waiting for an entry signal, you're waiting for a certain kind of entry signal and rejecting all others until it's time to change strategies. And I'll show you what to look for there as well. Okay, it's not about getting a signal. It's not about taking an entry. It's about getting the right kind of signal and taking the right kind of entry at the right time. Let me write to Ramos real quick, you guys. Hang tight here. Don't like it when folks are left out. There we go. Alrighty. So let's roll up our sleeves and get into it, you guys. That's the theory. Let's get into the hands-on application. Might have to be next time. Drew, wasn't in my lesson plan for today. Wasn't part of this particular trade setup. I think we have a recorded webinar that deals with pivot points. I certainly do on my YouTube. Just go to YouTube and search for FX Knight. I'm pretty sure I've got a video, but yeah. Now that I know you're interested, I can do one of these future Wednesday webinars on that. Sure thing. Alrighty. Now, last week, you guys, we took a close look at fibs. Fibonacci. Not talking about the sort where you don't tell the truth. I'm talking about the sort that reveal the truth. And then some. If you missed last Friday, don't worry. I'm sure we've got a recording of that either here on FX Street or up on my YouTube. And we're going to cover fibs again next week. There we go. Thank you, FX Admin. That'll get you to all the recordings that are on the FX Street archive. So feel free to review them at your leisure. And like I said, fibs we'll take a closer look at next week. But it is relevant to this discussion, so I'm just going to throw one up here. And if you haven't been to one of our prior Friday classes and you don't know how to use fibs, just follow along as best you can. Okay? And then we'll fill in the rest for you next week. Basically, we know we're in an uptrend. We're trying to predict where the uptrend's going to end, so we measure the beginning of the uptrend. And I simply draw my fib from the bottom of the wick to the top of the wick, the first part before we had our first major retracement. Okay? This is our first major retracement. Why did I skip these two? I should say reversal, really, rather than retracement. These are retracements. We hit resistance, double resistance, 21 exponential moving average and a Fibonacci level. We hit resistance, we came down, but we found support and came back up. That's why this is a retracement, not a reversal. Here we came down, found support, came back up. Here, quite the opposite is happening. We're not only breaking through support levels, we're retesting them from underneath as resistance. And then we break through more support levels, retest them as resistance, and breaks through more support levels. This is a downtrend. And remember, this is a daily chart. Okay? So this is a downtrend that lasted several days. That's not just a retracement. If you were long during this period, you might want to take some profit. You might even think about taking a short trade during this period. Doesn't mean we're never going back up, but you don't want to be long right here. This might not be so bad to sit through. Okay, so I'm talking first major pullback. The kind that breaks support levels and establishes new resistance levels. There's also a test that I do for this, and it's a relatively simple one. Stand at the back of your room and look at your chart from a distance and squint your eyes a little bit. Okay, often when we're not sure about something, we tend to lean in closer, don't we? We stick our nose right in the monitor. No. Look at it from a distance to see it clearer. And if you look at it from a distance, this guy and this guy kind of disappear. This guy totally stands out. Okay, so I measure the first thrust of the uptrend before the first major pullback. I'm not sweating the little ones. Okay, those of you that count Elliott waves, 3 up thrusts, right, is usually what you get before a major pullback. So that's how we measure the fib. Then we take a look at how far that pullback comes. In this case, 50%. So the first part of the trade, we would expect to trade up to 161. Okay? We didn't quite make it all the way there. Here again, this pullback I don't mind. We just broke resistance. We're retesting it as support. This pullback I don't mind. Double resistance level knocked us down, but we found support at the next support level. This is a break, retest as support before we go further. Here things change. We break support, retest as resistance. Probably don't want to be in for this. Okay. And this was the exit. I'll talk about exits in a moment, okay? Bear with me. You didn't even have to sit through this pullback. There was a clearly cut exit signal right here. And I'll explain how that came about. Eventually, we did make it to the 161. And as of this week, I've got reason to believe we'll go higher. So I'm going to show you 2 past trades, how a trade idea or scenario becomes a specific entry. First one didn't make it all the way to target. I'll show you how to spot the signs of an early reversal or an early exit ahead of target. My experience tells me 77% of fibs work out, meaning point C goes to point B, A and B being how you drew the fib. 77 work out. That doesn't mean the other 23% are losing. This is one of the ones that didn't work out. It stopped ahead of 161 on the first attempt. But it led to 2 winning trades. It was by no means a losing trade. So it doesn't mean the other 23% of the time you're going to lose. You're just going to have to manage your trade a little more actively. Okay? So we're going to look at 2 specific entries. We're going to look at the signs of an early reversal, where you might have to exit early ahead of target. And I'm going to talk about what I expect the pound dollar to do the rest of this week, maybe first part of next week. So you can't say it's all hindsight. Okay? A certain amount of it has to happen. Otherwise, we have nothing to talk about. Then it's all speculation. Okay? So I'll talk a little bit about what I think is coming up and what sometimes happens when you go beyond your detail. It's going to be a very educational session. We are going to have to move kind of fast to cover all that. Bear with me, but this is meant to be an introduction. I've already mentioned the YouTube. FX Admin gave you a great link to some videos here on FX Street. There's lots of resources for you to review and build on what you're going to learn today. Okay? Today is meant as an introduction or kind of an overview. All right, let me talk a little bit about what's on the chart, right? The lines have to make sense before we learn how to use it. Real quick, the bright purple line is the 21 exponential moving average. It's more or less my center line. When I'm above it, I know I'm in an uptrend. When it's aiming up and I'm above it, I definitely know I'm in an uptrend. When I'm below it, I'm in a downtrend. When it's aiming down and I'm below it, I'm in a confirmed downtrend. Pretty straightforward. This dim little jaggedy line here in the background is the same 21 exponential moving average, just from a higher time frame. In this case, the weekly chart. Okay? And the other moving averages I've got on here is a 50 simple moving average and a 200 simple moving average. Okay? This is a 200 simple moving average from the next higher time frame. The 200s tend to be really important. That's why I like to see them. You might be wondering, well, why isn't there a higher time frame 50 moving average? Well, most of the time, the difference between your lower and higher time frame is going to be a factor of 4 to 6 apart in order for them to be effective. Okay, for example, for the daily chart, the weekly is the higher time frame. That's a no-brainer. Nobody has a 2-day or a 3-day button on their trading platform. Okay, but sometimes it's not so clear-cut. You have, for example, a 5-minute button, and you have a 15-minute button. But the 15-minute is actually not the higher time frame for the 5-minute chart. It's only a factor of 3 apart. That's too close. The distance between time frames has to be just right, you guys. If they're too close together, it's not just a matter of pushing the next higher button. If they're too close together, they will almost always be conflicting. Then instead of getting extra insight, you get analysis paralysis. If they're too wide apart, well, they have no relevance for each other. Who cares if the daily chart is in an uptrend? It doesn't prevent you from going short on a 5-minute chart. Look at this. We dropped for 5 solid days in the middle of an uptrend on the daily chart. You can definitely take a short on a 5-minute chart during this period. See what I mean? So too wide apart, not enough relevance. Too close together, too many potential conflicts. Got to get the spacing just right, and we found a factor of 4 to 6 is just right. Well, guess what? If you're talking about a factor of 4, isn't your 200 the 50 from the higher time frame? Ding, 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 ding. There's no need for an extra line. I'm trying to be efficient and keep my charts clean. Okay, so the 200 pulls double duty. It's the 200 moving average from this time frame. It also represents the 50 moving average from the higher time frame. And if it's a factor of 5 or a factor of 6, it won't be exact, but it'll be in that ballpark, which is part of the reason I make my 200 a little bit thicker. Okay? Why am I using exponential for my 21 but simple for my 50s and 200s? Well, very simply, exponential puts more emphasis on the most recent price action. So for faster time frames like the 21, I want that quick response. I want the exponential. For longer moving averages like the 200, if I'm averaging 200 periods, what the hell do I care about the most recent price action? Right? I wouldn't be averaging 200 periods if I was. So it makes no sense to go exponential on the longer ones. And plus it creates a little bit of contrast between the two. Okay, so my rule of thumb, if you use different moving averages, my cutoff is 50. 50 and above, I go simple. 49 and below, I go exponential. The 2 dotted lines you see here that are more or less parallel, this is called the tunnel of 5. And as the name implies, it's a pair of 5-period moving averages. Okay, think of it as a buffer zone. Sometimes it's above the 21, sometimes it's below, but it lets me know when a trend is serious. Notice like during this uptrend, the candles really started getting bigger and longer when we came outside the tunnel of 5. And all of the pullbacks we had closed outside the tunnel. Once we closed inside the tunnel, we were done. Okay, so the tunnel of 5s makes me wait that little bit extra above the 21 to get into a trade, and it keeps me from getting scared, helps me stay in a trade once I'm in it, and lets me know when it's truly over. Okay, in this case, obviously, those support failed to hold before we closed here. I'm not saying it's the best exit or the first exit. I'm saying it's the exit of last resort. So tunnel of 5s kind of pulls triple duty. makes me wait to get in, helps me to stay in, and acts as an exit of last resort. It also makes me wait out a buffer zone before I get in the opposite direction, just to make sure I stay safe. And this is a pair of 5-period moving averages, as I mentioned. The difference here is one is applied to the highs, one is applied to the lows. Okay, usually moving averages are all applied to the close. But when you apply one to the highs and one to the lows, you get this tunneling effect. Okay? And I like to use smooth moving averages for this one. If you have MetaTrader, you have that kind of moving average built in. If you don't have smooth moving averages, you can substitute with an exponential. Smooth just uses a different way of putting more weight on the most recent price action. So that's what's going on top of the chart. Down below, no, I can't claim credit for it, Boyke. I learned about it from one of the banks I worked at. I don't remember if it was UBS or Deutsche Bank, but one of my fellow traders introduced me to it. I don't know who exactly invented it, but I certainly came up with a couple cool tricks on how to use it more effectively. So, underneath the chart, and there's people that say price action is king. I trade pure price action. I'm not opposed to pure price action. Don't get me wrong. As a matter of fact, I like to make my trading decisions above this line. I don't use the indicators for entry decision. Once I make a decision, I glance down and I use the indicators for confirmation. I'll never enter a trade just because the stochastics crossed, for example. But if I smell a reversal because the candles are getting smaller and the wicks are getting longer and support starts breaking and retesting from underneath as resistance, then I'll glance down to see if the indicators have also flipped. You see what I mean? People say indicators are lagging, don't use them. Well, I'm not trying to lead with lagging indicators. I'm making decisions based on pure price action. I'm just glancing down for added confirmation. You know, the analogy I always make, well, you could run a race with one leg, right? Heck, there's Olympians that have run races with no legs, right? But given the choice, I'd rather run it with 2 legs. See what I mean? Now, indicators are lagging. That's true. Price has to do something, then some math and calculation is performed on that movement, and then the indicator has some information to display. So, of course, they'll be lagging. The reality is, A, they're usually lagging by a few milliseconds. We're not talking weeks and weeks here. B, it is precisely their lagging nature that makes them so useful. If they did exactly what price did, well, they would look exactly like price and you wouldn't need them. The whole point is that they're lagging. Because remember I talked about retracements versus reversals? Look what happened when we had this pullback. Indicators remained bullish. That's how I knew it was a pullback. We had this pullback. Indicator more or less remained flat. When we started moving down here, the indicators started moving down. You see what I mean? They smooth out the noise of the market. Price says down, indicator says stay in. There's more to come. Price moves down, indicator says it's over. You see how I use them? It is precisely their lagging nature that makes them useful. Okay, but here's the thing nobody ever told you about indicators. That's because I wasn't moving it, Drew, but thank you. I think when it jams up, mine disappears on my screen, so I'll know, but thank you. I appreciate an extra set of eyes looking out. Here's what nobody ever told you about indicators, you guys. Not all indicators work all the time. If you've ever had a favorite one that you read about somewhere online and fell in love with and started using it and it worked okay and suddenly it gave you nothing but the wrong information. The indicator is not broken. What happened is market conditions changed. Each kind of indicator is designed to work under a certain kind of market condition. There's no such thing as in one indicator that'll work all the time, which is why I have a couple. Most indicators fall into one of two groups. Trend followers, like my OSMA here. Another famous member of this group is the MACD. They make calculations based on momentum, acceleration or deceleration. And they are the most useful in a trend. And here's the big secret, you guys. They're actually interchangeable. It doesn't matter which momentum-based indicator you use. Pick your favorite one. Pick it based on your favorite color. It'll work just as well. You'll notice I even use the same settings as the MACD, 12, 26, 9. Any momentum-based indicator will work in the top spot. In the bottom slot, I have the stochastics, and this jaggedy line is simply the stochastics from the next higher time frame. Okay? But this is what's called an oscillating indicator. It oscillates back and forth between 2 points. Okay? You can substitute the stochastics with an RSI. It'll work the same exact way. You just have to change 20 and 80 to 30 and 70 for overbought and oversold. Otherwise, it works exactly the same way. You could stick in the CCI, Commodity Channel Index, and then your overbought and oversold changes from negative 300 to positive 300. But you use it the exact same way. So feel free to pick whatever indicators you like. Just make sure you have one that's based on momentum and one that oscillates back and forth between 2 points. And if momentum is used during trends, it makes sense, right? When you're in a trend, what do you care about? Is it starting to slow down? Right? When you're in a range, what do you care about? Are we in a bullish or bearish wave of that range? Okay, so I use momentum indicators and trends. I use oscillating indicators and ranges. And here in the middle, I've got one called ADX, Average Directional Index. This is one of Wells Wilder's brilliant inventions. He also did the parabolic SAR. He did RSI. He invented a couple cool indicators. But in the case of ADX, notice I darkened out the plus DI and minus DI lines. Don't need them. If I put those on my chart, this becomes a momentum indicator, and it shows me the same exact stuff that OSMA does. Okay? I don't need it. I'm just focusing on the average line, and I drew a cutoff at 30. I mean, you can usually tell when something's going up, or something's going down, or something's going sideways. But the thing is, what matters to determine trend versus range is how long it goes up or down versus sideways based on what has come before. So what ADX does is it gives me a way to quantify it. So I don't have to guess. There's no gray area. Okay? If the average line is over 30, I'm in a trend, and I use the indicator that's above. If ADX is below 30, I'm in a range, and I use the indicator that's below. So think of it as an indicator selector. What ADX measures is strength. If I have a lot of strength, I'm going to break prior highs and prior lows and make higher highs and lower lows. In other words, the trend. If I don't have strength, I'm going to bounce back and forth between support resistance levels. And when you bounce back and forth between two levels, that's called a range. You see what I mean? So that's everything that you see on the chart. Now let's put it to use. Let me show you how I use it. Let's put our fib back up here. So we measured A to B. We noted where C was. We confirmed the fib with a good snap. Now let's talk about getting the entry timed out perfectly and using all these indicators together. Well, you can move up, Drew. Don't confuse moving up and down with trend versus range. You can move up in a channel, yes, but you're still bouncing back and forth between two levels, which is why the ADX is below 30. And you'll notice the bullish-bearish waves correspond with the up and down movement within this channel. See what I mean? A range doesn't have to go sideways. Range means you're bouncing back and forth between two levels. Triangles, up channels, down channels, still qualify as ranges. Okay? So, we got our C, we got our snap. Hypothetically, you can take your first entry. Now remember, daily chart is for outlining the big picture scenario. I don't actually take my entries and exits on the daily chart. I identify the windows of opportunity. And what I mean by that, we found support here. We closed on this line yesterday. We opened on this line today. Okay. I know this is the bottom of my box. Because it's a 50, I know the top of my box is by 161. So I know where price is coming from. I know where it's going to. And there's an added piece of information you know. Because of this open, I know it's okay to start looking for long entries today. So you see what I have? I've drawn a box. I have a bottom, I have a top, and I have a left side. I want to trade from here to here, and I want to do it right of this line. Look how much I know, and I've only looked at one time frame so far. I hope you're starting to see and appreciate the power of this. Okay, next move down to my 4-hour chart. Now the purpose of my 4-hour chart is direction. Yes, I know I want to trade from here up to here, and I want to do it right of this line. But is now the best time to do it? See, we're adding another dimension to our analysis. When do I act on this scenario that I've outlined on my daily chart? When the 4-hour direction agrees with the scenario. When the 4-hour direction disagrees with the scenario, it's not yet time to jump on the scenario. And if the 4-hour chart starts out supporting the scenario, but later on in the day changes direction, then maybe it's time to look for an alternate scenario. Maybe you're trading within a box and you've already hit the ceiling and now you're turning back down to move back down towards the bottom of the box, for example. Or maybe you drew two potential boxes and you're straddling the line right in the middle of them. And maybe you've finally chosen floor or ceiling, one box over the other. Okay? This is another thing that's going to help your trading and avoiding getting tossed around in whipsaw. You don't have to be a bull or a bear all day long. You're allowed to change direction, or directional bias is a better way of saying it. But don't change direction on the time frame you're trading on, ever. Go to the next highest time frame, again using our factor of 4 to 6, and then check to see if it's time to change direction there. And you're going to avoid getting whipsawed around. Okay? Direction only changes when the higher time frame changes direction. So when we go to our chart here, what direction are we moving? Sideways. We know we want to take a long trade today. But at midnight, when the first candle of that day opens, look, indicators are aiming down. They're not yet bullish. I cannot yet take a long trade. Okay? And in this case, I end up waiting 4 hours, 8 hours. Okay? Not on the first hour of the day, but the 8th hour of the day. Well, that makes sense. If this is midnight, right? Markets really don't get moving till 8 a.m. So what I'm doing, I drew my box. Now I'm fine-tuning its size. So what I'm going to do is I'm going to go ahead and move this line 2 candles to the right. Because look what we know by that point. Price came down a little bit lower. Look at our indicator. We have a bullish divergence. Our stochastics flipped up. Our higher time frame stochastics are green over red as well. You see that? And here we have a pair of dojis. We have a bullish open relative to those dojis. Well, now hold on a sec. Didn't I say you have to be on the correct side of the 21 and the 21 has to be turning in the direction of your trade? Yes. On your entry time frame. We haven't gotten there yet. The 4-hour chart is for direction. You can establish the direction as bullish when you're under the 21 as well. Okay, we're not hunting entries yet. We're just confirming that the direction is swinging around to support the scenario we're expecting from the day. You get me? So tunnel of 5s and 21 don't come into play yet. We're just establishing direction. But what we did is we fine-tuned our daily analysis by 8 hours. Okay? I moved this 2 4-hour candles to the right. Now I know the higher time frame's in agreement. Good price action, indicator support. Now I'm ready to go to the 1-hour chart, which is my favorite pair of time frames to trade on, 1 hour, 4 hour. Okay? What if you're a short-term trader? Does none of this apply? No, you still do your daily analysis every day. But then you're going to wait till the 30-minute chart changes direction to support the trade, and then you're going to look for an entry on a 5-minute chart. Okay, you still have a higher, lower time frame pair, and you still look for trades that fit with the daily scenario. Okay, that's how you adapt it. So we're still moving from here up to there. Now we're moving right of this line. We fine-tuned our box. Let's go to our 1-hour chart. And let's turn all that analysis into an actual entry. And here's where it gets good. Again, just because the direction agrees doesn't mean you right away go to your 1-hour chart and pull the trigger. We got to fine-tune a little further. We're going from this line up. We're going from this line right. But we are under this line. And the 21's not aiming up, it's going sideways, and we're under it, and we're not yet outside the tunnel of 5. So you wait till we break above the 21, retest it as support, and take your first open outside the tunnel of 5. Boom. If the indicator that ADX is favoring, in this case OSMA, agrees with the trade, which it obviously does. This is your entry candle. Okay? 2 4-hour candles after the daily gave you the scenario. 1, 2, 3, 4, 5, 6 hourly candles after the 4-hour approved of the trade. Here's your entry. You guys get what happened? Correct side of the 21. 21's aiming in the direction of your trade. Outside the tunnel of 5s. And the support of whichever indicator ADX is favoring. That's the magic formula. And by the time you get to that point, you're going to be trading with razor-sharp precision. Boy, that's a lot of waiting. That's a lot of things to line up right. But look at this. Do you really want to be duking out these teeny tiny candles that go back and forth with these little bodies and these really long wicks? Most of you are frustrated with your trading because you're trying to squeeze out pips during this mess. Look what happens when I wait for everything to be just right. Pow! Okay? Because I'm interested in trades that are going to go for a while. I'm interested in being right much more often than I'm wrong. I'm not interested in trading something just because it's moving. I'm interested in minimizing my risk, maximizing my profit. I don't mind waiting for exactly the right kind of trade to come along. Because in the end, I don't get paid based on how many trades I take. I get paid for the good ones. Okay? Now you might be looking at this, you're going, wait a minute, what's he talking about? We're inside the tunnel of fives here. Guys, this is a little discrepancy that happens when you analyze historical charts. Remember, this is based on moving averages, which means when you have a candle that's much longer than the candles before it, it's going to move. Right? Moving averages. The way I know this was outside of the tunnel of fives at the time, well, I traded it. That's why I picked it as an example, for one. But whenever you're studying historical charts, look at the close of the candle before. If this closed outside the tunnel of fives, which it clearly did, and this opened at the same time that this closed, wouldn't this then in theory have opened outside of the tunnel of fives at the time? And the tunnel of fives simply moved up after the open to print this way? Make sense? You get what I'm saying? Look at the close of the candle before when studying historical charts. On live charts, it's not going to matter. It'll be exactly where you need it to be. Just when you're studying historical charts, it's always the close of the candle before. This applies for tests of support resistance as well. For some things, fibs don't move. They stay put, but moving averages will tend to move on. Okay, it's always the close of the candle before. So yeah, break the 21, retest the support, 21's aiming up and we open outside the tunnel of fives, and we have confirmation from whichever indicator ADX is favored. There's your formula for a perfect entry. Real quick, let's talk about exit ahead of target. Very simply, where I started to notice that something's going wrong, we failed to break resistance. In theory, just like we have with every level before, we should have broken this level, established support here. But we didn't. And while we're struggling under it, look what we got. Another divergence, higher high on the price, failed to make a higher high on the indicator. But this is a bearish divergence. Look at our strength. Getting up to 161 would in theory require ADX over 30, right? Breaking resistance levels to make higher highs. We rejected 30 and turned down. So this, combined with the divergence, combined with a doji candle with its body under resistance and a bearish open relative to that doji, dojis are very telling candles, particularly when you open on the opposite side of the cross. Doji can be either continuation or reversal. If we opened on the upside of the cross, it would be a continuation. This, particularly happening under resistance, screams reversal. And then you look down, compare with the indicators, divergence. Failure to break above 30 and form a trend. Stochastics, look at this. Not just one stochastic reversal, but a double stochastic reversal. 2 time frames flipping from bullish to bearish. Some of you that have been to my prior classes, that's a perfect setup for a counter trend trade. And you know what? Maybe back to the 21. That's a great destination on a counter trend trade. Okay? So this fib didn't fully complete the first time, but it's not to say it's not a profitable trade. If you're a little more experienced, you can take the counter trend back to the 21. And once you find support at the 21 and your indicators turn bullish again, get right back into your original trade, trade it up to your target. So that's the first 2 trades along with the early exit. As far as what's happening now, once you get to 161 on your fib, one of 2 things will happen. You find a ceiling and have a reversal down, in which case you usually trade either back to your 21, just like we did here, or to your 0% fib, whichever comes first. And if one breaks retest, then you trade to the second. In this case, we got a slight reversal to the downside at 161, didn't we? But guess what? Indicators stayed bullish. ADX continued to gain strength. And we're outside the tunnel of 5. Trend's not over, baby. Now, this is a separate trade. I always get out at my target because I don't know what's going to happen next. I can always get back in. Same goes when you get stopped out. You can always get back in. Don't forget. Nowhere is it written one trade per pair per day. Or one trade per analysis, and then you have to throw it out the window. One scenario, one box, one window of opportunity can easily lead to several trades. You just have to know where you are within the box. Don't lose sight of the big picture or the higher time frame direction. What to do right now. And then you look for entries in that direction. So based on this, based on how we behaved with our gap, we had that big, huge gap when Larry Summers announced that he's not running to be the next Fed chairman because he wouldn't survive the confirmation hearings. Makes you wonder what skeletons he's hiding in his closet, huh? You know what? Looking at Larry Summers, I'd rather not know. But here's the gap, right? Here's the gap from Friday night to Sunday's open. The way I treat gaps, you guys, very simply. Here's where we closed at the end of the week. Here's where we opened at the beginning of the week. Once we go between the two, it's whichever one we break through first. That's usually the direction we're going to continue going in. And knowing that I'm above the 161, we're going to go to what I call the bonus round. Obviously, be aware of 6,000. Round numbers always provide at least temporary resistance. But once we hit 6,000, if indicators remain bullish, if strength continues to hold, next destination, I'm not saying today, maybe not even by the end of the week, though there's a good chance we'll hit it by the end of the week. But the next place I expect to encounter major resistance would be 6054. Fed news, we'll see what the direction is once people react to it. It's basically going to come down to tapering. Are they ready to commit to a firm date when they're going to start it? I think if it's more wishy-washy, markets will continue to be strong. If they firmly say, we're going to start tapering and it's going to be on this date, there's naturally going to be some softening, group. People are afraid of tapering because they think the stimulus is the only thing holding the economy up. They might be right. Unemployment's not coming down. I don't take the stock markets to be an accurate gauge of the health of the recovery. The reason stock markets are going up is because banks are buying stocks with your money. Remember the bailout? Basically, they created a crisis. Stock markets dropped to half of their present value. They got a bailout which was supposed to be used to increase lending, which we never saw. I know millionaires that can't get a loan. So they basically used bailout money to buy stocks while they were on sale for half price. That's why the stock market's gone. But the real measure of a recovery, I think, is a sustained drop in unemployment. And we just haven't seen that yet. We're only 0.5% down from what it was at its worst in 2008. So that's what it's going to come down to. Listen for either specific wording on tapering or more wishy-washy Fed speak. And that's going to determine bullish or bearish. Alrighty. So that's how a trade idea or a scenario turns into specific actionable trades in a nutshell, you guys. Here's where you can get some more information. I publish a daily newspaper. It's free. It's a summary of the most trending headlines on any given day. Guess what? Headlines tend to move markets. Not saying they should move markets. They just do, because that's what traders react to. So if you want to know what the buzz is, what all the newspapers are tweeting about and stuff, we scan all the social media outlets for all the major publishers and give you a summary of the topics that are the most trending. You can visit that link and get it. You can subscribe to have it delivered to you via Twitter or in your email inbox every single morning at 8 GMT. If you want more practice with the whole system, I know I skimmed over it very, very fast. We've got a series of recorded workshops you can watch. And if you found today useful, if you prefer the live trading, you guys, I do this twice a day, every trading day. We set up our trades not just on one pair, but across several pairs, every single morning. And we follow up at the end of the day to study what worked out, what didn't, and what we can learn from it, and fine-tune to trade even better the following day. Okay, we do that twice a day, every single day. Imagine what that would do for your trading results. And last but not least, we have what I call the budget program. It's only 29 pounds. This is called the weekly video updates. Here you don't get to interact, you don't get to ask questions, but every Monday morning we send you a recording of just the Monday morning session. Why? Because that's where we set up our scenarios for the week ahead. Okay? So there's some ways, and of course you've got my Twitter, my Facebook here as well. Those are some ways you can take your education further. And at the very minimum, you guys stop by fxknight.com and say hi. There's tons of free resources on the website as well. Only thing I charge for is my time if you want additional training. But you'll find loads of really useful goodies for free. And sign up for my mailing list while you're there. That way the next time we do one of these free webinars, we can send you an invitation. Thank you all very much. Thank you, FX Admin, for letting me run over. Really appreciate that. It's always good to do a complete lesson. Hope this has been useful, you guys. Hope it'll lead to some extra profit. And I'll see you a week from Friday for Fibonacci Fridays. Take care, everybody.